I think actually short term, we're in the closest thing approaching a buyer's market that we've seen basically since prior to 2020. The big if is if you can stomach the rate. We are seeing demand is down, building activity is in a recession right now, inventory rising, single family inventory, which won't perfectly correlate to property or farms necessarily. But as you can imagine, I mean, people are struggling. The combination of rampant inflation for the last 3.5 years, high interest rates, high mortgage rates, primes up, whatever your land loans are indexed off of, those rates are very high. And your buyer pool has shrunk. So obviously, if you can buy cash, which is a massive luxury, if you can just take the rate out of it. From a short-term standpoint, I actually think that this is a pretty appealing buy cycle.
This week, we have an economist. His name is Connor Lokar. He's a senior economist. He has done keynote speeches all across the country, works with small businesses, large businesses on forecasting the economy, throwing out the news and looking at data and looking at trends. And so we brought him in, and we're trying to relate all of this back to buying land, buying recreational land. And it's kind of a heavy topic, but I think if you listen to the entire conversation, you're going to feel a little bit relieved and have a game plan, a contingency plan. If you currently own land now or you're aspiring to buy land, Connor thinks that right now is actually a legitimately great opportunity. And I will just say this, the 2030s, according to ITR, which is who Connor works with, they're anticipating some hard times coming down the pipeline. But what follows is also very important. So I'm not going to spoil anything here in the conversation. I really appreciate Connor hopping on here and diving into all the different questions that I personally had, some other folks that I reached out to make sure we had really good qualified questions to make an impact for everyone listening here today. As you know, the Land Podcast is brought to you by Onyx, and we're throwing a little event. And it's coming right up, September 5th in Henry, Illinois, 6 to 9 p.m. And we're going to have a season kickoff, free food, free drinks, and we're going to premiere the first episode of Whitetail Cribs for this year. We're going to have a little projector screen. This is going to be a fun evening. Nothing too fancy, nothing too crazy. It's just going to be a lot of like-minded folks hanging out and talking about their upcoming season. So hope you guys check that out. And let's get into this week's episode. Connor, how's it going this morning?
Jake, thrilled to be here, doing well. Deer season's closing in, so excited for a great show.
Yeah, absolutely. So we have a lot of really big things to talk about, and I'm just going to throw you straight to the fire right off the rip here. Everyone is talking about recession indicators, and I want to know, as a guy, anyone listening to this, are there any key things that they can pay attention to without massive, giant data sets like you have available with your profession?
Yeah, it's number one, don't watch the news. Or if you do so, understanding that you're very rarely being helped by those headlines. You know, something core to, ITR Economics in our firm is like, we're basically no BS economics, I think is probably the simplest way to put it. We're rigidly apolitical, no bias, no spin. And just understand when you turn on the news and you're, the same data point, whether it's retail sales, inflation, you can find the perspective you're looking for on that data point if you roll through enough outlets, because it's, they're typically trying to tell you what they want the data to say rather than what the data is actually saying. So for us, our forecasting process, we rely just on the data, which kind of a novel concept, but we think that's a pretty good way to do it. And so we rely on a system of leading indicators. For normal people, kind of depends on what your, again, sole focus is. But, the Purchasing Managers Index is a great industrial input. We have a lot of custom composite blends that we built ourselves, from a macroeconomic standpoint, residential market standpoint, financial market standpoint that we publish. But the PMI, you look at some OECD leading indicators.
You got to talk like I'm in second grade, Connor.
Yeah, no, I'm sorry. It's, the stock market, I think as most people know, I hope that they know, that is not a reflection of reality. It's a reflection of asset prices, but in terms of actual economic fundamentals, the jobs report is a lagging indicator. Typically it's trailing the economy by about 2 quarters, which a lot of people don't understand, because most businesses are late to hire and they're late to fire. So today's hiring or firing is kind of reflecting on what's actually already been happening for a half a year at that point, good or bad, typically. So for us, I think from a housing standpoint, from a land and property value standpoint, I don't know if there's great ones, but if you go on Twitter, you can find the NAHB housing market index. That is one that we've found to be quite viable from a correlation standpoint to like the housing market, which will be a decent approximation for what land values might be doing or demand, lack thereof, building activity, things like that.
And what does that specifically show for someone that goes to Twitter right now and looks that up? What are they trying to gather from?
It's basically builder sentiment. And a lot of sentiment indexes are not good, but that one is one that is actually quite good. It's their housing market index. So basically they have a pretty comprehensive builder survey. And their responses are going to be reflective of obviously market demand, land acquisition cost, building costs, what's the consumer environment look like? Obviously a blend of, mortgage rate pressure plus or minus. So that's something that we track, and, it has about a 6 to 9 month predictive value for like future development activity. So generally, like if you see builders really feeling good and rocking, that's telling you that we're moving into an upcycle that's typically going to coincide with rising asset values, rising build rates, builders scooping up land as it becomes available to punch those plots in. And so that's one.
What's it right now?
It's softening right now. So that's something we're going to talk to today, where I think actually short term, we're in the closest thing approaching a buyer's market that we've seen basically since prior to 2020.
What I guess we'll just dive right into it. What makes you say this other than data? And yeah, I'm really curious.
The big if is if you can stomach the rate. If you can stomach the rate, we are seeing demand is down. We are seeing building activity is in a recession right now. We are seeing inventory rising, single family inventory, which won't perfectly correlate to property or farms necessarily, but we're seeing that, as you can imagine, people are struggling. The combination of rampant inflation for the last 3.5 years, high interest rates, high mortgage rates, primes up, so whatever your land loans are indexed off of, those rates are very high, and your buyer pool has shrunk. And, so obviously if you can buy cash, which is a massive luxury, if you can just take the rate out of it, we're seeing, in some, not all markets, like locally here in New Hampshire, we're so constrained from a supply standpoint, prices are just rising. But we're seeing in other markets, like even Florida, Texas, some of the hottest demographic markets in the country, people moving in there left, right, and center. We're seeing inventory increases, price cuts. So not that those states are necessarily super relevant from a whitetail standpoint, but this is, from a short-term standpoint, I actually think that this is a pretty appealing buy cycle. And
do you think that gets cut short if rates do drop? Let's say the Fed drops it by 25 or 50 basis points, or by year end we're 50 basis points lower, and maybe someone's buying, their rates went from 7 to 6 or 6.5 to I guess 6. So it's like it's still relatively higher than what people saw in 21, 20, 22. But do you think that gets combated at some point if rates do drop?
Absolutely. And Skip, who is one of my favorite guests of yours, he made that point in an earlier pod, that, what do you think prices are going to do if you see this dramatic, series of rate cuts? With that said, we don't think that's going to happen. Our view is that rates are not going to decline dramatically. Maybe the Fed finds room for 1, maybe 2 cuts. Our view is that they probably won't at all. Or if they do, they're only going to do that much, because our view is that inflation basically rises from here, whether it's all the costs in your personal lives or, asset prices. And it's not just because of tariffs, although it'll be portrayed that way. Fundamentally, the government has an addiction to spending money it doesn't have. And one of the most viable comps to asset pricing, and when I say assets, that could be land, that could be homes, that could be the stock market. We're seeing that the money supply is currently accelerating. We see that the government is still spending $1 to $2 trillion more per year than it's bringing in. All of that augurs for an upside inflation ramp from here forward. We don't think it'll be as bad as like 21, 22 peak rates, but our view is that inflation generally builds second half of this year, builds further in 2026. So we think that the Fed is going to be found wanting for justification to cut rates. And with that said, a lot of people falsely just assume that just because the Fed cuts rates, mortgage rates are going to go down. And you can look to this time last year and the exact opposite happened. The Fed jumped the gun with a 50 basis point cut. The bond market, 10-year treasury yields basically called their bluff and said, what are you doing? And we saw 10-year yields go up 75 to 100 basis points, even though that Fed funds rate came down. And it did bring prime down, but your long-term fixed rate borrowing costs are really going to be a function of that 10-year yield, which went up. So I think you're kind of Mr. and Mrs. Smith home buyer, and maybe to a certain extent property buyers think that if Jerome Powell comes to the podium and cuts rates, all of a sudden great things are going to happen on the long-term rate side. And it's actually not that simple.
What about, I feel that a lot of land loans are based off of prime versus homes going off 10-year treasury. So with that being said, if prime did drop, and you're saying they're not likely to drop, 50 basis points, but if they did, then do you think this model does play out?
Yeah, I think prices are going to go up either way. But if we did see a dramatic cut, bringing that prime rate down, that would just accelerate it further. We think they're going to go up with or without. If it's, you get 25 bips, 50 bips down, that could help a little bit on the affordability side. But, the thing with land prices, if you're fundamentally betting that they're going to go down, you're placing a bet that very rarely happens. If you just look at historical data, because you're basically betting that either demand for farms, whitetail properties, homes is going to collapse, or that the supply of those things is going to increase relative to that demand, which homes can often at the detriment of would-be recreation land. Cause a builder gets into that market, buys it to punch in 60 homes instead of a guy for a whitetail property. Or you're also betting that the federal government's all of a sudden going to wake up and become historically fiscally responsible, which that's not a bet I'm willing to make. I'm willing to bet that, because I get to see the data every day, that the money supply that's currently accelerating will continue to do so. Deficit spending that's currently going on is going to continue to go on. And all of that points bullishly for fixed asset pricing. Now, there is some unique, and I think your audience will understand this. There are unique opportunities. So I pulled from the USDA farm pricing as far back as they had it nationally for, which is only to 2011, unfortunately. But I think a recent cycle that people would remember, particularly any of your farmers, is that kind of 2013 to 2018 cycle. So basically coming out of 2013, going into 14, we basically had a generational global commodity pricing collapse. Corn went from $8 bushel to threes. Soybeans went from 16 to 8. We saw oil prices collapse. We saw natural gas pricing collapse. Industrial commodities collapsed. And in a market like Iowa, that video you and I talked about prior to this, that culminated in a peak to trough decline of 23% for land prices. Nationally, there was no decline at all. So if you are acutely in a market like Iowa that is kind of acutely in tune to those commodity pricing swings, that creates buying opportunities that from a national average standpoint don't actually occur. If we look at national pricing in that time, prices went down $10 an acre.
Wow.
So basically just flat. So for every Iowa that was down 20 points, New Hampshire, for example, there is no ag here. I've never seen a soybean in the state ever. So our, a lot of general Americans, they just kind of noticed from the summer of 2014 to 2015, they're like, hey, gas is cheap again. And they had a bunch more discretionary income to go around. And, they didn't mind. A lot of our client base that we forecast with, industrial manufacturers, fluid power folks, heavy machinery folks, they remember that cycle quite painfully. And, anyone in the ag world would too. And we basically have a similar, not quite as prolific cycle right now where we saw, ag commodity price, corn went back to 8, 21, 22, soybeans back to 16, 21, 22. And then now they're back down, soybeans at 10, corn at high threes. I think, we're looking at a record corn yield this year in the US. So we're in a market like Iowa or parts of Illinois and kind of any of those ag belt states, I think you're actually getting a better buying opportunity. We don't have that in New Hampshire or the Northeast. That's because we're not getting those ag swings, and we just have a fundamentally short housing supply position. And so those prices are just continuing to go up. So I think like for a lot of your listeners in that part of the country, times are tough out there right now. And I think that this is a pretty appealing buy cycle because just the historical outcomes where you're rewarded for not buying a farm today and buying it in 3 years, very few and far between. And that kind of goes back to one of our questions is like, is it always better to buy today versus tomorrow? Like not always, but typically. And in your markets, in your area, I think that, you actually get more of those buys than most of the country does.
That's fascinating because I do live in my own little echo chamber here in Illinois. And, do you think that now is because I know you guys do a ton of different forecasting. I know you were talking with a lot of agricultural and industry and manufacturer type folks this past week. What was this I know sentiments is usually not a good indicator, but what is your version of what the room felt like, top to bottom with what we just said here in mind?
I mean, a lot of industrial markets are soft right now. I mean, they were dreadful in 2023, 2024. They're actually improving now, starting to recover, starting to rebound. So things are getting better in the economy. So I fundamentally think like if you're trying to get into a property, I would really like try to make that happen in the next 12 to maybe 18 months. I think that things are about as good as they're going to get. Like if you're waiting for interest rates to look like they did 5 years ago, you're going to turn to dust while you wait. Like if that's like your strike point or like, I'm just waiting for that. You kind of have to resign yourself to the reality that that's not going to happen.
Mm-hmm. I don't think people like to hear that, but I think it's
I know.
true.
I know I give people the same advice, like just buying a home. I mean, it's like, you're going to cry yourself to sleep looking at that Zillow price history. And if you're just kind of like convincing yourself that that's coming back, you're not going to be happy with how things play out.
What about, what would you say to a fallacy? What I feel is a fallacy is, it's a conversation that's come up a lot more in the last 12 months than previously is, man, how much did they pay when they bought it 2 years ago? Or how much did they pay when they bought it 3 years ago? People don't like other people making money. Sometimes is what it feels like. What would you say to that person? Hey, I'm interested in this piece. They bought it in 2021 for X price. And now they're asking, let's say 2020, they bought 40 acres for $4,000 an acre in 2020. And now they're asking $6,500 an acre. I'm going to give an offer for $5,000. I have that conversation quite often.
You can't get hung up on that. I mean, the market price is what the market will bear. And, if you can afford it and it's like truly something you're trying to do to make memories with your kids, your family, your parents, whatever it is, like if you can make the financials make sense, like I don't think you need to get bitter about that person's good fortune of getting in before this inflation rocket ship took off. I mean, it's just, and another thing, like, again, if people are like rooting for asset pricing to like look like it did 5 years ago, you have to understand that like what the economic conditions that would like generate that are profoundly negative. And everybody always roots for recessions in these buying dips because they're always like, I'm not going to lose my job or my farm. Like that guy's going to lose his farm or job, and like I'll buy his stuff. Like everyone's convinced that like I'll be fine. I'll be the buyer, not the buyee. And maybe you're right. Like I don't know everyone's personal specific situation, but I think that the Great Recession, the housing crisis, financial crisis, 08, 09, I think convinced a lot of people that like residential real estate asset pricing decline is part of every recession. And it's actually not. In most cases, those prices don't even go down in recessions. Like that was the biggest downturn since the 1930s, of which housing oversupply, irresponsible lending was the star of, that created a pretty unique set of circumstances that was really traumatic for land pricing, real estate pricing. That is not like, you don't just get that in like kind of your 10-year recession cycles. Like that was very unique. And so I feel like everyone's convinced that like every dip is going to like basically, give you that 30, 40% decline in real estate pricing, but that doesn't actually happen like basically ever. So, particularly in an expanding money supply environment like we're in, I mean, it's
so what does it mean? What does it mean when money supply is increasing?
So basically it's the government is increasing the volume of US dollars, like fiat currency, not always like literally paper dollars. A lot of it's like digital conjuring of additional dollars, but kind of how I think about it, like basically every dollar that the federal government creates infinitesimally is basically devaluing the dollar in your pocket, the dollar in your checking account, the dollar in your savings account. Like life is not as simple as like if you just print enough money, all of your problems go away. And I think everybody's kind of realized that in the last 5 years. It's like, yeah, you print trillions of dollars in 2020, 2021. It's like really fun for a couple of years. And then the demand goes away. And then you're just left with the bitter, lingering aftertaste of excess inflation. Like that's kind of like the economy's basically been in that post-stimulus, party hangover for like the last 2 to 3 years. And so like when the government's printing more dollars, again, it's just more dollars chasing the same amount of farms, the same amount of like they can't print more land. Like we know that. Like they can make more homes to the detriment of land availability, but they can't fundamentally change that, which is why, I've long been a proponent of, and I say this selfishly because I'm a deer hunter, so I can I see it both ways, like the utility you get out of that property, but just like as a capital storage option, because sitting in cash right now and for the next 5, 6, 7 years is the worst thing you can do because the government's just devaluing that every single year. Like your $100, and everybody knows it buys way less when you get to the grocery belt than it did 5 years ago. And it buys less farm, and it buys less house, and it buys less of a pickup truck. And like that's currency expansion. I mean, like in a nutshell.
So for someone listening to this, maybe they're sitting on cash, or maybe they're grappling with the idea, because sometimes you brought up a point of being selfish, right? So I feel like sometimes people feel selfish. They feel guilty to quote unquote buy land or buy recreational ground. And I'm dictating this more towards recreational ground than a pure, piece of tillable or a big timber tract in the South or something like that. So I'm talking something that you've bought, something that I've bought in the past. Do you think that is a good place to potentially park money and deploy dollars to hedge against inflation, which is what you're saying is inherently going to continue to happen at maybe a higher scale than we like?
I mean, it's not the best from like a pure investor standpoint, because obviously like you'd want the tillable, you'd want the timber value, like you'd want like the additional cash flow to like, so like you're not just getting the land appreciation, you're also getting cash flow to kind of offset your property taxes or whatever else. But if you're using it, I think that's such a fair way to think about it, because, again, the downside is it ties up capital. And, so if the rubber meets the road in a bad cycle and you got to get out of your farm to, for the sake of your family, like that sucks. That's heartbreaking, but it's not going to kill you. I mean, we can go hunt public for a couple of years and figure it out. And, but I just fundamentally like, unless you're like have a bunch of cash sitting that you're actively ready to deploy into one of these big purchases, like you've lost, 30, 40% of your purchasing power in the last 5 years. And like, I don't think anybody's really been doing that, hopefully, but like that's, you kind of either, you got to be in the risk pool with equities at a minimum, take, what the bond market, money market's giving you, like take your free 3, 4, 5 points out of, just interest yield. And I think, getting some of that money in there. And again, if you're using it, like, that's why we're all here. I mean, like we all love this stuff. So it's just like, I feel like everyone's like, is this the right time? Is it going to get better? It usually doesn't. And I actually think surprisingly, like right now is not a bad time.
Yeah, I would agree with that. Just from what I've seen, I would agree there's less buyers in comparison. However, there's still a lack of supply. And so I feel like that's what's kept things in balance.
So I think that kind of like the other side of like, people are like bitter about other people making money. I also think there's a lot of would-be sellers that don't want to accept the reality of the market today compared to maybe like 2 years ago.
Yeah.
Like
there's a lot of housing data. There's housing data that has recently been published.
Like, I don't think that they like want to accept that prices have actually maybe gone down a tiny bit, or it's just, again, not this feeding frenzy buyer's market or seller's market that it was 2 years ago. So they're like, well, I'm not listing. I don't, I can do better than 5,000 or 5,500 or whatever it is. And so I think that that's kind of like a little bit of supply side reluctance with home sellers too. I mean, they're like, like I want 10 offers with no inspections, and like I get to pick my favorite one that's 15% above list. And it's like a lot of markets aren't like that anymore. those kind of have disappeared, and now you're getting back into stuff selling closer to lists. You got to get it inspected, and so it's not the feeding frenzy that it was 2-3 years ago, because that money's dried up. Inflation soaked it up, and people are struggling to keep up.
Mm-hmm. Yeah, that's you look at this data, you live in this every single day. So that's what had me so excited for this conversation, because we can all hypothesize, and to your point, we can try to read articles, or we can try to get some unbiased information. But you have no dog in this fight. You're just sharing the information, data that's in front of you.
Yeah.
What about the Benner cycle? So the Benner cycle, for anyone listening, is this old thing from a long time ago, I think from the 1800s, of this farmer that predicted all these different market cycles of, bear market, bull market. And I asked ChatGPT this as well. And it's like, that's about 50% right.
Mm-hmm.
I'm sure you cringe when this gets brought up, but I have to bring it up. What is your opinion on the Benner cycle? Because I think a dummy like me looks at that like, 2026 is a time to potentially buy, according to this that was made 100 and some years ago.
So stopping short of like endorsing it fully, core to ITR, our firm is basically business cycle analysis. So basically the same, we're not following, what Benner said, but our review is that there is an inherent predictability and forecastability of business cycles on both like a 1 to 3 year basis and longer. Honestly, that's really made us, successful over the years. One of the most frustrating things, and a lot of your listeners probably don't live in this world, but like when the Fed comes out with a forecast, or like JP Morgan comes out with a forecast, and it's like they show the historical data of the cycles over time, and then their forecast is just like a horizontal line for the next 5 years, which like basically reflects, the last 10 years average growth rate. And it's just like, okay, you might be close in terms of what that 5 year average is, but like if it's +5, +3, -3, +2, like, for like our business manufacturing clients, like if you manage your inventory headcount cash flow for, +3% every year, but it's actually +15, +10, minus, like you're going to be massively out of position, short and long, like throughout all of those cycles. So, it's like quarter, like our logo is a business cycle, and kind of that sine wave cycle over time. I mean, that is what we do, is like business cycle analysis, business cycle forecasting. So like, and I think I was reading about some of Benner's stuff too. He like talks about solar cycles a little bit, and he was like heavier in ag than we are. But I certainly think that there's credence to the cyclicality of these markets, and that they're actually a little bit more predictable than I think people think. And that's kind of like a differentiator for us in terms of how we approach our forecasting, like where we don't forecast like a horizontal line. Like we try to forecast the highs and lows, the ebbs and the flows of these business cycle. And we've been successful with that. And it makes it a lot more actionable too, than being like, yeah, things are going to rise on average 3.6% over the next 5 years. It's like, okay.
Yeah. Bold take. Yeah. Thanks.
Yeah, exactly. It's like,
if you want to know where property boundaries are for public or private, you want to develop a great plan for your farm, document perfect access to a blind, to a tree stand, carve out and measure food plots, connect your Moultrie Trail cameras to an app that shows exactly where they're at, and you can look at the feed for that specific camera location, then Onyx is something you need to check out. It is the only mapping software I use when it comes to deer hunting. I've tried other pieces of software, different apps, and I always go back to Onyx because I think it is the most comprehensive, easy to use, and robust mapping software there is when it comes to hunting and land ownership. You want to send a pen to a friend, boom, send it to them right to text, opens it up. Maybe you have notes, maybe you have pictures on that pin, transfers all of it. You want to send a whole entire folder of a plan that you mocked up, you can do that on Onyx. So be sure to check out Onyx. They are a huge supporter of the Land Podcast. They allow us to travel around and talk to some folks that can give you really good insight and good information no matter where you're at in your process of buying land. Let's get back to the conversation.
What about, so for a guy that works a regular job and he says, hey, I want to be in a good position. I want to, and it seems like it boils down to not being in just plain cash. Like that seems to be something to avoid. Now, if they're not quite ready to buy a farm, you mentioned a high yield savings account. I mean, is there anything else that you could, give as friendly advice, not financial advice, to have on the radar for the next 12 to 18 months as they're saving up to buy a farm potentially?
Yeah, I mean, you kind of have to be in equities. Like it's kind of the only game in town. Obviously, the safest way to do that is, with like index funds, ETFs. Anytime you're picking individual stocks, your returns can be huge, and any year like NVIDIA investors, listeners are, they've probably got 500 acres right now. They're doing all right.
I don't have that much, no.
But it's just, you just can't, and like 10 years ago, it was still a bad idea to sit on cash, but like it was only costing you point and a half in inflation a year, but now at 2.5%, 3.5%, like you're just losing purchasing power. Like my sister's a great example. She's smart as a whip, but she's like book smart, not like financial smart. And she like sat on cash for like 7 years. I was like, you can't do that. Like you like literally have lost purchasing power and also left heaps of return on the table. So you have to be actively invested. I won't touch like cryptocurrency or anything because that's like too much variability there for me, but you got to be doing something. And even if it's reasonably conservative, that's better than doing nothing, because you want whatever nest egg you're trying to build for a farm down payment to at least rise commensurate with those asset values. And obviously the hope would be you make some really intelligent investing and you can actually exceed that. But you're just going to find, and I'm sure a lot of your listeners kind of have felt like that in recent years, where they're like, I'm saving, I'm trying.
You saw a treadmill.
Like it's just like, I feel like I'm not getting closer. And that's the thing, like, with money printing and government stimulus, like it's horrible for normal people, middle, low income. Like, the people that already own farms and homes and have big stock portfolios, like they made out like bandits over the last 5 years. Like they were land rich, now they're land richer. They were house rich, now they're house richer. They were rich, and now they're richer. The normal people that didn't own a farm, didn't own a home, didn't have a big pile of, liquid assets in the stock market, they got their heads caved in. And I think they realize that now. But that's why, like, just government spending is so sinister, because it's, a lot of the people it like purportedly helps, it actually hurts the most. And it kind of exacerbates that wealth gap issue. So it's, kind of the way I look at it, it's just like, do you want to get on the asset inflation escalator, or do you want to keep watching it go up from the sidelines? That's kind of what it comes down to.
Do you believe in the core quote of, time in the market versus timing the market? Because someone listening to this now, I think everyone thinks they're the exception of the rule, and like, oh, I'm really smart and I'm going to be able to time this land purchase perfectly, and I'm going to get a 20% discount, and it's going to be the perfect farm at the perfect time with a discount, versus, somewhat serendipitous moments where you're like, hey, I bought the farm I like, and holy cow, you look up 4 years later, 5 years later, 10 years later, you're like, wow, this is substantially worth more. Because the polar opposite of that, to your point, is like you're not able to gain traction.
Yeah, I think 9 times out of 10, time in the market's better. Just get into what you can afford. Because, and particularly for what we're talking about, like recreational land ownership and hunting, it's just like, you're also making memories. You're also having a great time. You're working on the farm, where it's just like, like let's say like a buying opportunity is coming in 7, 8, 9 years is, when we start talking about the 2030s, it's just like, okay, well, what's the price on 9 years of not owning and not having a blast and learning and, figuring out what works, what doesn't. So I generally feel like, you're better off getting in than really trying to time that up. And, you can get lucky. It's, so it kind of goes back to like, I think if like any of your listeners that are kind of ready on the edge, on the precipice now, I'd say it's time to go, like time to find something and get in. If you're not there and you're not particularly close, then we can kind of talk about an opportunity that we maybe think's coming in the 2030s, where maybe you kind of start building life around trying to time that up. Like if it's not really like, it's I'm buying tomorrow or next decade, or if it's like, I'm not actually really that close, I'm just trying to get there, then maybe we have that opportunity coming.
Yeah. You kind of touched on this earlier, but I just want to ask it point blank. Do you believe land is more resilient during times of economic uncertainty than other forms of investments? And let me add just a little bit more context too. So other forms of investments, maybe rental house, maybe it is in equities or just an S&P 500 index, like where, and I don't know if you have data to back this up, but I'm just asking for your own gut check on it.
Like in normal cycles, typically, I mean, if I look at that national USDA, real estate trend, I mean, it's gone up and to the right for 15 years, and we've had plenty of stock market corrections in there, a couple bear markets. Your land value, really the biggest downside of land is just it's not as liquid. Like you don't get to pull up your E-Trade account and bust, X out of it in 10 seconds. It takes a little bit more doing. And like when you get forced into a property sale, like that's when you can get really screwed over. But if like you're confident that you can hold it, I mean, I view it as like a capital storage vehicle and like an inflation hedge vehicle, not like your most appealing return vehicle.
Sure. With the cycles you've seen, and you just mentioned it's gone up into the right for the last 15 years, but for someone listening to this and maybe they're getting spooked right now and they're like, oh man, I don't want to be forced to sell. I have a farm and man, I don't want to sell it if times get tough. Based off of market cycles and data, what's a realistic emergency land fund? So it's like, hey, I can pay for this farm for 6 months, 12 months, 18 months. In your opinion, what do you think is a very conservative benchmark for someone listening to this?
Like 6, 12, 18 is like for normal cycles, like that's plenty. That, like normal cycles, normal dips. I mean, that's like probably more than you need, to be honest. In the more sinister cycles, that might not be enough. And we see that one of these generational dips coming in the 2030s. So
let's just dive into it.
We're talking around it. We're nibbling around the edges. So for those of you, I presume most of you don't know ITR. So we have been predicting for 11 years. I've been with the firm for 11 years, and we kind of debuted this theory around that time. We have been predicting a Great Depression coming in the first half of the 2030s since that time. The causal drivers of that outlook is basically a culmination of the things that everyone's, particularly in the last 3-4 years, have become more aware of and are wondering, like, when does this stuff start to matter? That stuff being the fact that we have $36+ trillion in national debt, the fact that the government is, for the last 3 to 4 years, and way prior to COVID, just the numbers are crazy now, spending $1 to $2 trillion more per year that we bring in. The aging baby boomer kind of demographic time bomb that will be and is relentlessly upward pressuring government spending commitments for Social Security, healthcare. And the most sinister is now our interest expense. So interest expense on debt already accrued, that 36 trillion and counting, is now exceeding over $1 trillion per year. It is basically going vertical. It is larger than our defense budget. In the month of June, for example, the federal government, kind of their inflow outflow statement, like we ran a surplus in June. I don't know if anybody saw that headline, and it was largely because of tariff income. And I know the Trump administration is excited about that, but kind of the buried lead was that 27% of every federal tax dollar collected is instantly earmarked for interest expense.
That's crazy. So
basically, quarter and 2 pennies that they're taking from you, light it on fire. Like, it doesn't get you anything. It's not going to defense. It's not going to Social Security. It's not going to any government. It's just like, for the pleasure of rolling debt already accrued, just throw it in the trash. Done. Like, and then we got 77, or 73 cents to work with for everything else.
Yeah.
So basically, our view is that there is no free lunch, that eventually this matters, and we think eventually is in about 5 or 6 years. And so when we say depression, like, we're talking, like, if it were only as bad as 2008, 2009, we'd call that a win. Like, that we'd think that that's getting off easy. So we're looking at like a 3 to 5 year event, not linearly on the way down, like not like a hot stone for 5 years straight. Because if you look at that back of the 1930s, which I know everyone's mental imagery is going there right now anyway, that wasn't, it was like down, false bottom, and then we started to come out of it in the back half of the 1930s. And we're looking for something similar. And that kind of, maybe not Benner specifically, but like that kind of longer term cyclical view, generally get recessions every 10 years on average. This will be about 100 years out from the last depression. And it's just everything that outlook was built on 10 years ago, like, has gone as bad or worse than we thought it would. COVID was a complete disaster. Because it basically put government spending on steroids. Mm-hmm. We thought that the 2020s, going back 11 years ago, we thought the 2020s would be characterized by higher and rising interest rates, higher and rising inflation. We've gotten both. And again, like, 5 years ago, like 2019, like we were running like a $600 to $800 billion annual deficit, which was, the worst we'd ever seen at the time. And then now it's like, gee, I wish we could get back to 6 to 800 billion a year, because we're doing, a couple of the, like last fiscal year, it's between 1 and 2 trillion, 1 and 2 trillion. And we just view it as untenable. Some other economists disagree. They're typically like Keynesian economists, modern monetary theory economists, which we call modern monetary theory. We call that the magic money tree. Because basically their worldview is like, no, none of this matters. We're the world's reserve currency. We issue our own debt. Most of it's internally held. We can just keep doing this forever. And again, I just subscribe to the theory that, like, if that were true, we'd be the Jetsons by now, right? Like if just printing ungodly amounts of money fixed all your problems, like everybody would have a farm right now. Like everybody would be fine. Like it would be, it'd be utopia. But the reality is it's not. People are buckling under the weight of high interest rates, high inflation. The government finances are as poor as they've ever been and deteriorating. So like that's, when we think about buying opportunities, like that's like kind of the next big one, we think. Because we do think that in that cycle, we will see hard asset pricing decline, equity, market decline.
How bad?
And so,
and let's tailor it more towards land. I know there is no precedence of this, but that's what all these guys are thinking in their head.
I don't think I wish that USDA data set for national pricing went back to 0809, because that would kind of basically, like, that'd be your starting point probably.
Yep.
But again, that cycle was unique because housing was so focused, and we don't really think housing or land prices, like that's not really the core of this theory, where like that was like a housing show pretty much. Yep. But I don't know, just throwing a number out there in the absence of a forecast, I'd say like 20% is probably a starting point. Like we think equity markets will get beaten up at least 30-40%. So when you start running the math, so like I think like that kind of goes back to like you're either getting into a farm today, like this year or in the next 12 to 18 months, or you're kind of getting into that wait category. Like we roll a lease for 3 to 4 years, we just keep hunting public, and we kind of wait out that next big dip. Because I still think you have room to get in a farm now, ride inflation for 2026, 7, 8, 9, 30. There's going to be actually a lot of inflation as things start to unravel. The government's going to try to print their way out of it first, because it's like, to fix these issues, they have 3 doors: spend less, tax more, print more. Printing more is the path of like political least resistance. They're gonna be like, maybe we haven't printed enough money, so like let's try that first, and we think that that'll blow up. So we're predicting like at the end of this decade, we might see some years with inflation rates back in the high single digits, like kind of at the very precipice. So like I think you have some room to get up, and then if you come underwater or down anyway, like is it going to get you back to 2025 pricing? Like maybe it's close, but like if I asked you, like if you basically don't have a farm for 8 years and you get a 5% discount in 9 years relative to today, like what's that worth to you? Like,
so my perspective is I'm buying it. And if all this comes true, I'm going to have enough cash to weather a storm to where maybe you can go slightly on the offense. Maybe your neighbors comes up for sale. Like, and so that's how I would position it. But and this is what you do for a living. You are the clear expert, but I'm just going to play devil's advocate for a second. There's all this discussion too about wealth transfer as well, of folks aging out, passing away, and then this not my generation, but our parents, getting this influx of wealth as people age out. Is that factored into your guys' forecast to any degree?
I mean, it is. We don't think it's a saving grace. And in fact, I think the government's going to be pretty sinister. I think that they're going to try to get in the middle of that transfer and take a bite out of it, which is like horrible, because they've taxed everybody every step of the way on the way up, and they want to get you on the way out the door too. But like, I think they're licking the chops at that kind of like boomer to millennial wealth transfer. So like, I know like current administration, they're trying to like basically help, like to limit the tax burden to pass on a farm, to increase the thresholds to trigger that estate tax, that death tax. But I think by political necessity, and I don't know who's going to be in power when this all goes down, there's going to be pretty popular sentiment, wrongly, but I think the sentiment and support's going to be there to basically go for asset-rich people that are dying, which is, again, horrible. Like I don't like, they've taxed you every step of the way. Like, but again, there's going to be anything they're taxing on now, they're going to tax more. Anything they're not taxing, they're going to start taxing. Because it's just like the entitlement piece of it. It's an immovable object. Like the politicians are like, cut the defense budget, cut the department of whatever budget. And it's just like, okay, but that's like pennies in the bucket comparatively to, 85% of entitlement spending is Social Security, Medicare, Medicaid, veterans benefits. Like, and I think it'd be like they can't touch any of those. Like it's not going to happen. So it's like just that cost burden is going to rise. And so we think this can, and this is happening globally, by the way. This is not just a US problem. In fact, like Europe is in a way worse position. China's in a way worse position. Japan, South Korea, way worse position. So like that's also part of why we think it's going to be so bad. It's not going to be like the United States having our own little.
It's a global.
Yeah, we think that this is a global problem because it's really a relic of the I don't want to blame baby boomers. I don't want it to sound like I'm doing like my parents are baby boomers. But it's basically demographic imbalance where birth rates plummeted post baby boomers. And like, so it's kind of your classic inverse pyramid, like boomers are this big, Gen X, millennials, and like there's insufficient forthcoming tax base to basically replace those folks. The US were actually in a pretty good position because we got the millennial boom in the United States. There's actually more millennials in the US than boomers. Unfortunately, we kind of squandered that demographic advantage by just spending above our means for 60 years at the government level. But like there was no millennial boom in China or Europe or so they're like, everyone wants to talk about like China's eating our lunch. They're kicking in our teeth. They're running circles around us. China's a time bomb as far as we're concerned, economically and demographically. So I'd rather be us than anybody else. That doesn't mean we're not going to have problems, but it's just that it's something I want people aware of because I think this is a massive opportunity if you're prepared for it. If you're just, if we're levered up to our eyeballs, we've got a home, we've got a second home, we've got 272-month, new car payments at 7% and outstanding equity line of credit. And just like if you're levered to the hilt and just like assuming chart goes up into the right forever, some people are gonna have some big problems. But I think that it might be a kind of a catch-up opportunity for people that probably aren't feeling great about their situation right now. Mm-hmm. If they play their cards right, like this might be your chance to get in. And when you say the depression word, everyone jumps to like their 1930s high school depression,
in the textbook class, where the lady selling apples on the side of the road.
Yeah, it's like the Dust Bowl and like the whole thing. Yeah. It's not going to be that bad. I mean, there's much more of a social safety net now than we had back then. And if we're talking about unemployment rates of like 15, 18%, 20%, that also means an employment rate of 80%, 82%, 80. Like people are still going to have jobs. People are still going to own farms. They're still going to make their payments. But yeah, so people are going to go under. They're going to be forced to sell when they don't want to. Some businesses are going to go under. But when I talk about this in a business context, at keynotes at shows and stuff, it's like you're going to have massive acquisition opportunity. But you're going to have a war chest to draw on, basically, to survive some lean years. But kind of that eagle capitalism, like this is your swoop opportunity. And Jake, how old are you?
I'm 30. 31,
so you're 30.
31 in 4 days.
31. I'm 33. So like, like you were probably a couple of we were going into high school in the Great Recession. Yeah. I was in high school in the Great, it's like, yeah, I sure wish we were buying residential real estate in 2010, right. But we were teenagers. So it's like, we kind of missed that one. Yeah. And so, and like a lot of people are in that bucket and it is a chance. Like, I don't want to scare the daylights out of everybody, but this is something we've been predicting for a long time. And the closer we get, our confidence in this is going up.
How are you preparing?
Debt consolidation. Really just primary residence mortgage is pretty much all I want to have. And really just, again, take what I can get in terms of aggressive investing now. Because I got 2 young kids. My wife's not working right now, so I'm a single income household, and which we wouldn't have any other way, by the way. It's great, but just really trying to I want that dry powder keg to play with to when we get there. So, again, I think the recipe for disaster is, really just if you're playing it fast and loose, because again, this advice doesn't kill you. Like, let's just say we're dead wrong. And we do a follow-up pod in 10 years and you're like,
I'm already looking forward to that. Honestly,
you're like, Connor, what happens? Just I don't think anything I'm advising you to people to do, that's not going to kill you. But if you don't listen and it does happen like that, that might. I personally think, I just think it's impossible that nothing happens,
For sure.
Maybe we do what Japan has done, which is not grow for the last 15 years. They've just been slow bleeding down into the right. We think it's going to be a little bit quicker and hotter burn, and then we rebound. By 2036, actuarial projections indicate that, half of baby boomers will have passed on at that point, which again, I don't say gleefully, like my parents are baby boomers. I want them to live forever. But that's basically when the math starts to tilt back in favor.
What's your level of conviction in this on a scale of 1 to 10? Personal
9.
conviction. Okay. All right.
Yeah. And again, I think the quibbling is not what is something bad going to happen. It's like the exact composition, timing, severity, duration. So my lack of confidence isn't that it's not going to happen at all. It's going to be like, again, how does it look? Like, is it as bad as we think it's going to be as quickly, or is it a more drawn out process? I think I guess we'll find out when we get into it, but I think I'd rather have like the quick controlled burn than like the 10-year forest fire.
Well, whenever you see the chink in the armor or the glass start to break and crack, you have an emergency invite to come on the podcast and say, hey, pay attention. I ask that of you.
I will absolutely do that. And I think, I think you could argue we're seeing the early cracks right now. I mean, like the last 2-3 years, I mean, like the symptoms that we thought we would see would be rising interest rates and rising inflation. If it wasn't the pandemic, because like we didn't predict that 11 years ago, obviously. But if it wasn't that, it was going to be something else. And if, because the government, it's just like, the political cost of doing anything proactive is up here and the political cost of kicking the cans down here. And until that changes, nothing's going to change. And we don't think that math changes till like we're in it. And we also don't think like, even if they did decide to get smart today, like we think it's kind of too late anyway, but probably not going to happen. So
I listened to I wish if I would have known we would have went this exact direction. There was a podcast I was listening to and they were just joking about, like the debt. Like, well, what if the government did for the boomers, a wealthy boomer that gave a portion of their estate to the government to help with the deficit, the next 2 generations does not have to pay income tax. It was like a way out in left field, and they were just saying it tongue in cheek and joking. But they did a little bit of math to where it would actually somewhat balance it out. And that's about all I remember of it, because I know it sounds absurd and crazy and would never happen. But I thought it was a funny thought exercise.
Yeah, but like again, that boomer piece, it's like, again, think about like a lot of farms are going to get passed down. Maybe the kids don't hunt. They don't care. They can't afford it. Maybe they lost their job and they're like, God, I would love to keep this. But so that's kind of your opportunity piece of it. And it's really just, and again, like 20% unemployment means 80% employment. Like people will still have jobs. Like the country will still exist. I would rather be us than anybody else globally. Like, again, it's like, I'm going down with the ship here. Like it's not like I want to move to, Costa Rica or something, like try to ride this out. Like fundamentally, we're long America. And when we think we rebound back half the 2030s, we think the world's our oyster for the 2040s and 50s. We think our relative advantage in terms of economic size relative to the rest of the world actually probably grows coming out of this. And so, kind of depending on where you're at in your life, like this is either really scary or maybe almost exciting from an opportunity standpoint. I think the toughest people, because baby boomers will fully be retired at that point. Like they will have already built their nest egg, and like their job is just going to be play defense play defense on inflation, tax code changes, and just kind of manage your way through. At our age, it's not great because we're going to get taxed till our eyes bleed in the 2030s. But we're young enough. We're going to get the rebound, the asset reappreciation, stock market reappreciation, economic recovery and rebound. I think kind of your 50, maybe like your late 40s, early mid 50s listener right now, I think it's probably most awkward from a life timing standpoint because, if you're going to be, again, like early 50s, mid late 50s, like in 5 years, like that's kind of like your peak savings years. Like kids are out of school. If you chose to pay for it, that's done. You're at the apex of your professional career, your maximum income potential. And that's like when people really put the afterburners on like their kind of final retirement push. And I think they're going to, just make sure you're paying attention. Cause again, and your wealth advisor, by the way, if you talk to them about this, they don't want to touch it with a 10-foot pole. They want to go back to like the time in the market, 100-year advice, which is all good advice on the 100-year time scale, which is like, don't do anything rash, 60-40 equities, bonds, like just kind of don't do anything crazy. But what we're talking about, if it comes true, is like a once in 100-year, retirement math ruining event, possibly, like if you play it really poorly. So it's
Yeah, well, it's a heavy topic that I'm sure I'll get text messages and questions of I should have asked you this, so I apologize. This is so far outside of my scope and
I know
daily
it's
conversation, so it's been really fun for that. Let me ask you this, and I want to dive into your guys' first farm purchase too. But it's 2030 and it's June. Are you going to sell your farm to go buy a bigger one in 2 years?
no, absolutely not. And we'll kind of get into the unique land dynamics here, like adjacent parcel purchases. So like my dad is like the official owner, and
Hmm.
so presumably, hopefully, it gets passed on to me. But like our goal is like anything adjacent comes up, and again, our market's like so unique, and we'll get into that. But yeah, we are so perfectly content with where we're at. And again, like that's honestly like when you ask like what am I doing, it's like obviously I want to make sure the house is okay, and then basically I want to make sure that I'm not in a position where I have to sell that farm because we'll never touch this piece again in terms of like how perfect it is for all the needs that we were looking for. So it's like, I'm already thinking about like annual property tax payments, like how many years do I got to have just kind of like farm fund. Like I will, also, you know, short of dying, like I will do anything not to have to sell that.
Buckland Funding. If you don't know who they are and you're looking to buy a piece of ground, I encourage you to reach out to them. They're chartered in multiple states across the Midwest, and they understand recreational land. I've said it a million times here on the podcast. The most important piece of buying your first piece of ground is finding a partner, finding a bank that understands what you're trying to do, that has competitive rates and understands the world of recreational land, because not all banks are created equal, and Buckland Funding understands our crazy goals of scooping up a piece of ground to enjoy it with family, to hunt it, to use it as an investment. They understand that and work with that every single day. I encourage you to reach out to them. If you're in the process of buying your first or 20th farm, reach out to Buckland Funding at bucklandfunding.com. Back to the conversation.
Well, I think that just shows how much passion for anyone that buys a piece of ground, works really hard to get it, of how much that just becomes ingrained into who you are. So we were talking earlier, it took you guys, because typically I ask, how long have you been looking and things, all these different things. So give us kind of when you guys knew you wanted to buy a piece of ground, and we'll just kind of ease into it.
Sure. So, for us, like, so like I'm the New Hampshire land guy, like one of the few, like, but we're actually from Michigan. So I was born in Michigan in the early 90s. My dad grew up in Michigan his whole life. He was a deer hunter, hunters on both sides of the family. He'd get a buck or two every year. I kind of had your normal hunting upbringing, like go out with dad, brushing the ground blinds, it was baiting back in those days. So like we'd go out and like put some bait out, or, go out on blood track, which for people with young kids, like that is hunting or otherwise. I think that's like the earliest memory I have is like my dad liver shot like a 5-pointer, and like we all went out and tracked it, and it was like the coolest thing ever. But then my dad's company got acquired, and to like kind of maintain his professional journey, we had to move from Kalamazoo area, southwestern Michigan, to New Hampshire. And I was 9 years old at the time, so I wasn't even youth hunting yet. But basically overnight, we went from like everything's flat, ag land everywhere, deer everywhere, to nothing is flat, there is no ag, and there are no deer. It's just like New Hampshire was just so different. Like functionally, it's very similar to like northern Michigan, northern Wisconsin, northern Minnesota. Just low deer density, no ag, high predator numbers. Just kind of, you don't have that kind of rhyme or reason of like big ags here, kind of your cover seams, woodlots are here. They're gonna, yeah. It's like kind of so like diagnosing the process like immediately, because like I remember like seeing a deer in the car on a drive was like an event those first few years, because there were so few deer, and there were also really bad winters back then too. The herd's in a much better place now than it was then. And so, I started bow hunting, and, I think I had like the perfect hunting upbringing, like my first 3 deer were button bucks with my bow. So rest in peace to those future booners. But, then I graduated to spikes and does. And then like we talked about, so the Great Recession hits, I'm in high school. And that was like why I'm an economist now, is like it was such this transformative event. And maybe for you a couple years younger, you might have, I don't know if you'd remember it or not, but basically like overnight, every adult in my life started talking about the economy for the first time ever. Like teachers in school were talking about it, my parents were talking about it. Like remember my dad being under a tremendous amount of stress because it was really bad. And so I was like, I kind of want to study that. And so I went to the University of Michigan, repping the colors here today.
Yeah.
And so, and at this point, I'm just like sick with hunting. Like I'm just like, I've got the bug bad. And I distinctly remember my freshman year, I was like walking to the library, and it was like that first October, like high pressure bluebird day, like northwest wind just ripping leaves off the trees. And I just like immediately felt sick. Like I wasn't homesick. I was like tree stand sick. I was like, oh my God, like I have to be hunting. So my sophomore, junior, senior year of college, I found some permission pieces, southeastern Michigan. And just like, I'm just like seeing more deer in a day than I'd see in like an entire season in New Hampshire. And it's like, and these weren't even like great properties, but I'm just like having a blast. And I was like, there's gotta be a way to do this in New Hampshire. Like there has to be a way to like, cause it'd be like mixed ag setting and I'd be like, okay, cornfields there, covers here, get in on the right wind. And I don't want to make it sound like it's easy to kill like mature bucks. And people are like, roll out of bed in Iowa, you're going to land on a 160 or whatever. And like, I'm not going to do that, but
I love that you're reminiscing about Michigan hunting too.
Yeah, I know. Like, like for all your Michigan listeners, they're like, God, it's so hard. And I was like, oh my God, it was like, paradise. But so then I graduate in 2014, degree in economics. I start with ITR full time out of that. And my dad was in, because he hunts and he's all over it. And again, like he grew up hunting in Michigan. He's just like, yes, New Hampshire stuff's pretty tough. And I don't want to make it sound like it can't be done, by the way, because we have incredible hunters in New Hampshire, but it's just different. It's just a different setting. And so every day for 7 years, like I would open my work laptop, start up my work Outlook, and I used a website. It was called New England Real Estate Network, where I basically had like a land search saved for like kind of acreage minimums, maximums, towns that we were looking at, and just like every day, every listing that came up, screening it. And because like my dad was in, and he was the money man, basically. We went with like the buy once, cry once. Like we went the more discerning, wait for the perfect farm, the perfect thing. Where like if it were just left up to me, like my dad didn't hunt, or if he wasn't into it and it was like just me, I would have prioritized like when I bought my first house, like it's got to have some acreage, like get into 13 acres, 17 acres, whatever it is. Just like whatever I could make happen. But eventually, as we got to 2020, like, so we've been looking for 6 years, and I'll service the sponsor here. So OnX was extremely helpful when in this search, because I didn't have it. I think the first couple of years we looked, I hadn't downloaded it yet. Mm-hmm. But like, I don't know how I'm sure your listings have to be better in like the Midwest, but like the land listings were so bad online. It'd be like it'd be like a 0.5 megapixel picture of like the road frontage and like the plat map. And so I go to look it up, and I can't tell, is it on the north side of the road? Is it on the south side of the road? Is it like, and so we drive out there, and it turns out it's like the side of a mountain. It just goes straight up. And it's just like, okay, it's 80 acres, but we're not going to be food plot. We're not. So once we got OnX, I could save a lot of driving time for us both and be like, okay, this is just not what we're looking for. And we drove out to a bunch, and, basically our requirements on the purchase side was proximity. Like we wanted to be within 30 minutes where we lived. And we also wanted it to have like pre-existing fields, which is actually kind of hard to find just because we don't really have fields. Because like, your listeners and a lot of your guests, like the worst thing you can do on a new farm is just like immediately find the first clearing and put a food plot in. Because like quite often it sets you up for access issues. It's not right for the prevailing winds. And I agree with that 100%. But out here in New Hampshire, we're the granite state. It's live free or die, and we're the granite state. And so like, unless you have like a limitless dozer dynamite budget, like you just don't know what you're going to find, like where you think you want to put a food plot. Like you could be hitting rocks the size of my head, or the size of a four-wheeler, or the size of a house. Like you just don't know what you're going to find. So that, like, we were hoping it wasn't a deal breaker, but we were hoping to find that. And so like we screened a bunch, we looked at a bunch, we walked a bunch, and it just was never quite right.
It was over a 7-year period.
7-year period. Yeah. And and I will say New Hampshire is incredible from an access standpoint, from a public standpoint. So like there's no shortages of spots to hunt. There's kind of a unique program here. Maybe the Midwest states has something like this, but there's basically like a current use designation for land where you basically get a massive property tax break, and it like makes your land open to the public. And it's like basically the state encouraging that for opportunity. And it's not like people can go on your land, like cut down trees or ride four-wheelers, but basically like for hunting, they can come on. And between that and like state and public land, lots of opportunity. So it wasn't like we couldn't hunt unless we owned private. Like we just kind of wanted to try to replicate, what you watch on TV. You want to plant a field, make it green, shoot something while it's eating it. I mean, like that was the dream for us. And so in 2020 hits, and kind of being blessed and cursed with like my job role, I'm like, and seeing the stimulus, seeing all the inflation indicators that were taking off, like I was like, the train's leaving the station as far as pricing is concerned. I mean, like that, it was clear as day that like things were about to be really bad in terms of if you're like hoping to buy anything like that. But again, like we weren't going to force a purchase, and we just kind of got extremely fortunate that in September 2020, a 110 acre piece got listed that was close. And it was really like some nasty topography, creek and wetland kind of bisecting the whole thing. And the only reason we were able to get it is because of that. It basically, the home builder buyer was out. Like some builders looked at it, and basically the amount of money they would have had to put into like infrastructure, wetland remediation, hoping that the town would play ball with them. They looked at it and they're like, can't do it. Because I know for a fact, based on comps, like if that was fully developable with like minimal inputs, that piece would have went for in excess of $1.5 million. Like it would have been just way gonzo, like no shot. But because of that, it was just kind of relegated it to like, who wants a 110 acre hobby farm? And like, there was a lot of those people, but probably not as many here as like maybe in the Midwest. Cause I don't want to say there isn't a hunting culture here, because there's a lot of great hunters in the state, but it's not quite as like intense, I would say, like on a per capita basis. I just don't think that there's as many people doing it as you would see in Illinois, Iowa, Michigan, Wisconsin. So we're able to get into it. Closed in November 2020. I remember like the Christmas of 2020, because like I had been like for 7 years while land searching, consuming an unreasonable amount of like land management content for someone that did not have a particularly direct line on any sort of land management. But I was just like, watch. I was like, someday it's like whether it's me or me and Dad, it's going to happen.
Yeah.
And so that first Christmas, it was an absolute riot, because like I had the shopping list right. I was like, Dad, you take care of the land, I'll take care of everything else. So it was like, your Packer Max Cultipacker, your Nick Nations Habitat hook, your Earthway bag spreaders. My dad's like, what the hell is all this stuff? And I like wrapped it all up and like, for family Christmas. He's like, I was like, trust me, like I know exactly what we're going to do here.
I'm prepared for this.
Yeah. Which was also really lucky, because, obviously it's not just like asset pricing that went up, but like just like consumer goods, like, 18 months later costs like 40% more. So I was able to get almost all of that stuff bought up prior to that, drag harrows, sprayer, like just all the stuff that you have to have, which is, it really reminded me of like when I bought my first house in 2016. Is like, you buy a house and like you cut the biggest check of your life, and then you're like, oh shoot, I have to spend a ton more money to put stuff in the house. And it's kind of like the same thing with a farm. It's like if you haven't owned one all your life, it's just like you don't have any of the stuff. And it's just like, I actually kept a spreadsheet for a while of like tracking my expenses, which was, for mental health, maybe not a great idea. Just like kept that one hidden from the wife. But yeah, so we just
was it a multiple offer scenario when you guys bought that?
I don't know if she got an official second. My dad just went right to list, which kind of based on the time was kind of a win to just even get it at list, because like stuff was already starting to like go nuts, like way above list. So my dad just kind of came in pretty strong and direct. Like the day that we walked it. Cause like he knew, like as soon as the listing popped up and I looked at it like online, I was like, this is it. Granted, I had said this is it to my dad like probably 12 other times in the prior 7 years, and when it definitely wasn't it. But like as soon as we walked it, like, I mean, we got like 100 yards into the property walk and we're like, yeah. Cause it has fields that were like horse hay pasture mix, like 12 apple trees that are like 50 years old. It's got the creek, it's got the swamp, it's got a pond. It backs into like 1,000+ acres of just undeveloped, nasty swamp topography, just like big buck heaven, basically. And so it hit everything that we were looking for. And where the fields were or are, it's like they're oriented kind of like right up kind of like where we park. It came with a barn. There's like, not like an old school barn, but like 2 garage doors, a little finished living area. So it's like the perfect deer camp. Because that was another problem with buying out here, is a lot of the bigger acre pieces also had like a 250-year-old farmhouse on it. And my dad's like, I'm not looking for some maintenance nightmare to retire in where I'm going to be working on the house more than I'm working on the farm. So like trying to find a big piece that fit what we wanted, that didn't have, because that also blows up your property tax burden massively, because there's, your taxes have structure on there. So that also made things hard over the years. Like we found a lot of pieces that were compelling, but it's just like, you got like a 3,500 square foot, farmhouse that's been built on 10 different expansions over 200 years, and like, foundation from like the Pilgrims or whatever. And so So we got lucky, I would say. Because again, if that listing didn't come up, then fast forward to 2021, whatever came up would have been 20% more expensive, then 20% more, and we would have been in the same boat as a lot of people. But for all my YouTube watching, nothing can replicate actually being on the land and doing it yourself. I remember the first time, that first spring I wanted to plant clover. I'd never worked an earthway bag spreader, and they're like, setting 1.5, and I'm like, is the paddle supposed to be behind the 1.5 on it? And so I dumped out a half acre worth of clover seed in 30 yards. And I was just like, oh, this is. So there are definitely some humbling moments in there. But now we've got 6-7 acres of mostly clover. Planted brassicas first year. Deer had no idea what to do with it because these deer have never seen a food plot ever. It took them till December to start they're like, oh, this is food. This is cool. It's, but then we got to shed hunt for the first time because we actually had a food source to shed hunt over, and they're finding sheds on the property, and so just all these things that are just the dream for people aspiring to that land ownership. I had a hunt, I think it was our second fall, where I saw in one sit over our biggest kind of open area, I saw 15 deer in one sit at one time, and it was 14 does and fawns and a sporky, but that number, particularly to your Midwestern listeners, probably most of them see that many, or they'll see 30 in a field, but that's an incomprehensible number for what we were doing on public just 2 years prior. That's just you don't do that. When I was a kid, I was if I had a hunt where I was 90% sure I heard a deer that was probably definitely a squirrel, I'd be like, yeah, that was a good hunt. I'm definitely thought I'd heard one, if I thought I was in the vicinity of a deer, I was yeah, it was a good hunt. And so it's been, I killed a buck in 2022, our second full season on it, that I never put the tape to him. I have the mount. He's probably 160, which is
wow.
He's got 150 covered all day long. I don't know if he'd get quite to 160, but, a deer I never thought even was possible in the state of New Hampshire. Not that they don't exist here, but not many of them. And it was, he was working through the swamp, trying to go up to our, kind of our destination food, the furthest north fields, sneaking through a swamp 5 minutes before end of legal light, exactly what they're supposed to do. And, he ran into the the wrong end of a 300 on that one. But so it's been fun. I mean, and it's not we can't match anything that, Midwestern states are doing. And we'll still, we'll shoot 1.5-year-old bucks. I mean, we're not above that and does and stuff. And we get friends out to shoot stuff and get a better hunt than they're going to get anywhere else, locally anyway. So it's been really amazing. For us, it's not about 200 inchers in New Hampshire. It's about 200 pounders. Big for us is everybody goes by body size, because it's really routine throughout the state to get a very mature 4, 5, 6.5-year-old 8-pointer that's 105 inches, to just because the nutrition in the soil is so bad that's just what they are. But he's 212 pounds, so you get a 200 pounder patch from one of the local clubs cool. here. And so I think for property owners, it's your expectations have to be realistic, fair relative to the area. I'd be sour grapes if I thought that I was gonna have Southern Iowa in 2 years, and if that was my benchmark for success, you're just not going to get there here, and that's fine. It's we've already kind of exceeded our expectations on what we thought was possible, and we're still working on it. Our soils are so bad. Food plotting, again, I've been realistic with what to expect. I actually think we've done better than I thought we even would. But the prior owner had the property logged in the fall, winter of 2019 going into 20, the year before we bought it, which was actually perfect, because that would have been step one for us anyway. We maybe would have logged it a little bit harder, but it was a pretty good aggressive select cut. But if you came out and walked it, you'd think it was cut 18 months ago, not 6 years ago. The regen is just so slow, and the deer on, any of the woody browse are just on it so hard. It's we're finally starting to get some white pine regen that's getting to 3-4 feet. So I think we're 2 years away from it being really good. But it's it's just everything. I've planted a bunch of apple trees, and again, I watched some like, guy in Wisconsin with like dirt black soil. And I was like, God damn it. His tree's like a year old and it looks like better than my one that I planted 5 years ago. Like what the hell's going on here? But it's been a lot of fun and it can be done. Like everything that you watch on the Midwestern videos, like you don't have to be kind of in that ag belt to do this stuff. I mean, some cases, some stuff's not going to like, year 2 of switchgrass that's still like 20 inches tall. It's just like, because it's just like I'm planting into like sand and rock. So I don't know if I'm going to get, 6 feet in year 1 or 2 or 10 maybe. But it's just like doing all this stuff and applying the lessons and like listening to your content and everything. It's just, it all works. You don't have to be in Iowa to do this stuff and have an absolute blast doing it. And like, I don't think you can put a price on the memories that we've made. And now I've got a 2-year-old son, 5-month-old daughter, and, son comes out with me on the side by side and putting up trail cameras. And it's just like, it's the best. And it's just like, so kind of wrapping to where we started this. It's like, you have to, it's impossible to do, but you kind of have to think about, it's just like, think about that 2030 outlook. It's just like, okay, like maybe in theory, again, if things play out exactly as we think, you could technically get a farm for cheaper in 8 years than maybe you can get next year, but probably not by that much. And, what's the cost of the 8 years of memories that you didn't make,
Well, and then more than likely people, at that point, if it is full on chaos in the economy, you're scared of potentially losing your job, more than likely that guy's probably not going on the offense.
That's a great point. Yeah, too. It's just like, so you kind of have to plan on not only having the powder, but like
having the nuts,
the fortitude to, like, put it on the table and go do that. And that is way easier said than done, for sure. And again, particularly if you got a family and everything, and you're just like, can I do this or not? So, but it's funny, like I love, like I said, Skip is such a great guest, such a smart guy. Love listening to everything he says. And, he said, when you like, how do you approach your first season on the farm? Like, and he's like, hunt it light, hunt it smart. We did the opposite. We did the, you gotta, break some eggs to make an omelet. Like all my stand locations really prioritize like visibility over killability. And we've got like tough topography. So like, I was like, we just got to figure out what these thermals are doing, which you can only do so much on OnX and you got to get in there. And so like, we did blow out a lot of deer that first year, and like not a single stand I put up that first year survived its initial location. And some of them only moved like 30 yards, but like invariably, like every move was either to shorten access, improve access, or like realize, okay, this is actually a thermal bowl. I thought it was safe on a south wind, but every time it would just go right back to the deer. And I got winded like in this one stand every single time. And I just like couldn't figure it out. I was like, the weatherman says the wind's going south and my milkweed is going straight.
The very, very first hunt on where I live, same exact thing. It's like someone in the bottom and like, oh yeah, the wind should just do exactly this. And I somehow got winded or spotted. I still don't think it's spotted by this matriarch doe. And I'm like, how in the world? And needless to say, I pulled that stand down.
I can't stand the matriarch does. It's right. And the other thing, so like Jeff Sturgis, love his content. And he was like kind of one of the, like, there's so many people now and they're all great, but Jeff was like kind of one of the OGs. Like if you just look at his YouTube catalog, like he's got some of the earliest content there. And, because of the way our food's situated, it's like right up, we basically have to go through the food to get into the property, which, as you know, like that's a disaster for morning hunting. Like all of our success has pretty much been evening hunts. And so like I had to like, I'll give Jeff the credit. I'm sure other people have talked about it, but post daybreak stand entrance, for example, like that's the only way we can morning hunt. And my dad hates it.
Yeah. Because it feels like you're being lazy or late.
And, he just grew up normal hunting in Michigan and I did too. It's just like, you're supposed to be in the woods 30 minutes before sunup and watch the woods wake up. And that's what you do. And I'm like, Dad, like, do you really think all these deer are going to let us just wave at them and walk past them? And then an hour later, they're going to walk right to where we went. It's like, we're going to blow the whole farm out. So like, that was a big change, getting him on board with that. But it's, it's like, that's kind of like, to that, we just don't have any food. And then, that's kind of like the big advantage that we have, relative to the area. And so that's what, like, I think he's getting older too. He's just like, kind of get out there like an hour later. That's not that bad. But initially he's just like, what the hell are you talking about? Like, it's like, we got to get in there. And it's like, that's not going to work. But yeah, it's been fun. I'm trying to think, what else
What would be
I
one
don't
piece of what would be just one piece of advice for someone that maybe they have the down payment right now, or maybe they're diligently saving over the next, by the end of the year, they think like, hey, I'm going to be ready to start farm shopping in 26. And I feel like you probably already hit on this key piece of advice, but is there anything else that you can think of that if you had to jump back in the market and pretend you guys don't have the 110 acres and you're back on the search, what would you do anything differently, or any key pieces of advice that we haven't covered?
Honestly, seeing how fun it is now, like, and again, like, just pretend my dad didn't exist and like it was just up to me, I would just get into whatever I could afford. Like if it was, checked a few boxes, but maybe not all the boxes, like I just want to get into something because it's so darn fun. And it's, again, like all the economic factors we talked about, again, it still gets you into a piece. You get to start riding the escalator. You get to start learning how to do this stuff and just making memories. It's, I think being overly picky, particularly if you're younger, it's just, I think it costs you more than it helps you. With my dad's situation, like, again, he wasn't trying to buy a farm and then flip out of it into a new one. He's just like, if we're going to do this, like, we're buying something perfect, or we're just not going to do it. So
I think that's a lot of things that's something that I think a lot of people struggle with, is they have to bargain shop. And then when they bargain shop and they get something, they're like, man, I wish I would have been either more patient potentially, or B, they wish they would have paid a little bit more to get a higher quality farm. I feel like that's a trap that I think some people can fall into.
Yeah, for sure. And so it's just trying to look at my notes here if there's anything we didn't talk about. Yeah, I think we covered most of it. It's like, just for us, like, I don't have a channel or anything, nothing like that. I'm just a consumer of the content. But as far as what we do at ITR, we're pretty unique. Like, our audience is typically like business owners, executives. Like, we're consulting like with like manufacturers and like helping them forecast their business and presenting at industry conferences. But like, just for your kind of everyman, your entrepreneur listener, your person that's just trying to buy a farm and they're just sick and tired of turning on the news to try to understand what's happening in the economy, and then like 10 minutes later they're like, I feel worse than when I started this journey. We have a lot of content on our website that's for free. We've got blogs, mini trends talks. We have a YouTube channel we have a weekly Fed Watch segment, actually. Like, so if people are kind of locked in on interest rates and inflation, every week, ITR Economics YouTube talk about, as our thoughts evolve on the Fed, if we're going to get a couple of cuts later this year or not. There's a lot of stuff like that you don't have to pay for that is just so much better than any of the main, like, I don't even, again, because like we have 15,000 data sets, and I just like, there's the, like, doing your own research thing. It's like, but like literally that's what we do, is our own research. Like, I don't even know, like, if I didn't work for this company, I don't even know what I would do. I was like, I don't understand how people survive, like, trying to understand what's happening based on just the poor quality of reporting out there, because it's so, like, CPI will come out and I read a headline. I was like, that's weird. And I pull up CPI in our system. I was like, I don't even know how they're getting to these numbers, or like this portrayal, or like, retail sales. It's like, consumers dying. And I pull up retail numbers and they're like the best they've been in like 2.5 years. I'm like, what is going on? Like, where are they getting these numbers? So we just play it down the middle, no spin, no bias, just, good, the bad, and the ugly. And there's usually a little bit of all three. But if you just want no BS, economics, that's, look up ITR for sure.
Awesome, man. Well, thank you so much. I really enjoyed it. And anytime you feel that there's a breaking newsworthy podcast, you have an open invite, because I feel like people want to be informed and they want to kind of sift through the BS. And I feel like that's what you would be able to provide. So you have an open invitation, and anytime we need to know something, come tell us. Yeah, absolutely. And hopefully I didn't scare people off too much with the 2030s, but yeah, I'm going to keep listening. And if we have something big change in terms of what we think, I'll shoot you a message, and, we do a little emergency pod, do a little deer season update, and kind of go through the economics. So love it. Well, thank you so much.
Thanks, Jake.
There you guys have it. Hope you enjoyed this episode. Want to say thank you to Onyx, Moultrie, Hawk Optics, Painted Arrow, Buckland Funding, and ASM Labs. They're the tax soil guys. So we have a group of partners here that is really an extension of a potential team for you when you buy your first farm, between Buckland Funding and ASM Labs, and from the gear that you'll need when you buy a piece of ground. So I hope to see you guys next week. Thank you so much. We'll see you.